Hey guys, hope you are all having an amazing weekend. The market is going through some serious bearish conditions which have had everyone on their feet. Today's video is going to be quite complex, as it will give you an overview of everything happening, what my thoughts are regarding whether we are about to have a market crash, what this means for the squeeze, what I think await GME and AMC, crypto market and housing market relationship to what is going on and everything in between. This is all meant to do one thing only: give you a solid and firm understanding of what is happening so that you can set your expectations aligned with rationality and can make better decisions. As you might already guess, we have much to discuss, and I want your feedback, so do not shy away from letting me know in the comments below. In fact, let me up you a bit and extend my invitation to join my Discord where I will be answering questions directly to everyone. Hope to see you there after you watch this video. Before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's get started. The stock market is falling and it has everyone on their feet. Not only that, but the cryptocurrency has vaporized over $1 trillion in days. It feels we are on a downward spiral and everyone is screaming market crash is on the horizon. I reject this idea. I don't think this is a market crash, even if the charts align perfectly with that of 2008. I am going to explain why I think this is not a market crash for the next couple of minutes, but you also need to know that just because it isn't a crash doesn't mean we are going to be a huge green candle one day that's going to rally the markets and catapult us into the stratosphere. There are many caveats to what is happening right now and you need to be keenly aware of it if you are to benefit current market conditions to your favor. Let's begin with the basics. No, I don't think this is a market crash. I think this is a big market correction that was long overdue after markets enjoyed the best rally in history. The biggest reasons that led to this abrupt market correction come from a mixture of different situations taking place in the economy. People love to undermine the severity that new variants have and the overall impact that they cause in the economy. Omicron variant, for as weak as it is, have spread very quick and led the biggest spike of infested people. This has strained a lot of the labor force as well as hospitals. Though we are seeing increasing global vaccination rates to try to get things back to normal, new variant arrivals have always pulled the rug out of the market's feet and sent us tumbling down. The effects of this pandemic are serious and vast, and no matter how good a vaccine gets, as long as people get sick, it will have its impact in the economy and the markets will feel it sooner or later, and reflect the strains with a slump of whatever magnitude it is. Another big factor that is partially responsible for this market correction actually comes from the Great Resignation. Millions of Americans are quitting their jobs seeking new opportunities because employers are failing to adequately pay them. With the rising costs of society, the minimum wage is no longer a valuable proposition to hire, much less hire competitive and permanent talent. The pandemic brought upon us a psychological shift where individuals reassess their life goals and trajectories, and many are demanding better workplace conditions and salaries. Due to so many jobs finding themselves with no staff, it has set back a lot of the smaller but much needed mechanisms in the economy, and now we are seeing part of the result of this on the stock market. The next and perhaps biggest factor contributing to this market correction should come as no surprise to loyal viewers of my channel. Inflation is eating everything up. It's eating the saving accounts, it's eating that small raise of 2% your employer gave you, it's eating away your credit card balance and groceries cost. Consumer prices rose 7% year over year for the month of December, soaring past conservative estimates and painting a bad predicament of things to come. As I have said, when we talk about inflation, 7% is bad, but that's not the worst thing. The actual worst thing of this 7% figure is the psychological effect it will have on investors and the rest of the country for that matter. As the Fed continues to break promises and government officials look helpless in being able to take control of inflation, people begin to lose trust in these important institutions and begin to become more and more uncertain, and uncertainty is the worst enemy of the stock market. Bad numbers suck, but they are easy to hedge around and move past, but uncertainty is different, because you have no numbers to plug in. Your ability to protect your assets based on prediction made in the dark is as good as mine, and it makes people panic, especially investors. And this brings us to the next big weight hammering markets. The Fed's tone somehow continues to get more and more cryptic, and the things that aren't mysterious are actually bad. The Fed is hawkish, which has manifested in them promising to raise interest rates. There are about 3 to 4 interest rate hikes planned for this year, and the stock market is not taking to this kindly, but due to the Fed's own mistakes during the onset of the pandemic with the intention of isolating Wall Street interests at the expense of the rest of us, they are now undoing much of what they tried to preserve. Valuations of stocks are high, and a growing amount of investors are agreeing that perhaps it is too high. When the stock market becomes more and more detached with the happenings of the real world and the financial hurdles citizens are going through, the stock market will be more vulnerable to what I call reality checks, which would be conditions of weakness where the market will react more bearishly than usual since the foundation of its assets' values are believed to be so unrealistic. These are the biggest fundamental reasons why the stock market is slipping down with no apparent bounce back yet. Of course, there are other conditions that have accentuated the fall in value of the stock market. That last Netflix report really kicked the market down, and with so many other big tech earning reports coming out soon enough, the market is getting anxious. There are many investors who think Tesla will not have a good earnings report, and if Tesla disappoints investors this week, I think we are going to be sliding down just as bad if not worse than we did on Friday. Microsoft is also expected to have their earnings soon and Apple too. Many think Amazon is also going to yield less than enthusiastic numbers, and investors are of course pulling out because on a bearish market, cash is king. People want to average down and they will sell larger positions to accommodate themselves for better profits. When we talk about the stock market, we cannot ignore cryptocurrencies anymore. They are both so attached now that what happens on one market will reflect to different degrees on the other. If losses on stock markets have stock investors depressed, the losses seen on crypto have investors on life support. What triggered this fall, aside from the growing weakness of the stock market, was the recent proposal by the Russian central bank to ban cryptocurrency. The Central Bank of Russia stated it was proposing to the government that all use and mining of cryptocurrencies on Russian territory be banned. Russia granted cryptocurrencies legal status in 2020, but resistance has been growing over the years, with officials citing threats of terror financing. But perhaps the biggest reason for this sell-off is Wall Street. You see, Wall Street has been pumping and dumping crypto for the longest time, having investors jump in out of fear of missing out. Now, with much liquidity needed to cover positions aside from the prospect of being able to buy stocks for cheap, they have been withdrawing funds. As big and popular that crypto is, no way does retail traders make up for the extreme growth crypto has seen. This is big money investing in this stock to get others to join and then pull the rug, leaving others at losses, which will result in panic selling. Once it reaches a predetermined floor, big money will hop on back in. And now that we have a more than solid understanding of the mechanisms driving stocks and crypto down, we ask ourselves, is this a market crash, and how much lower can we fall? I don't think we are in a market crash. In fact, I am confident we are not. The reasons are multiple and some more complex than others. Let's begin with my favorite one, the housing market. I have made so many videos talking about the housing market and the relationship it has with Wall Street. In essence, Wall Street has been working hard to park as much of their money in the housing market. The reasons for this are multiple. Wall Street figured out post the 2008 recession that investing in the housing market was very lucrative. Ever since then, they have been buying houses without the intention of selling for the most part, but rather renting out. In the more modern times, with inflation shooting up, Wall Street found itself in a tough situation. They love the stock market, but investing all the money there could be very risky since they know everything is overvalued, but staying with cash on hand is also a bad idea, because inflation is eating the value of the dollar. As months go by, your buying power becomes less. As such, Wall Street came up with a great idea, and that was to increase their investment in the housing market, parking the money there so that they protect their wealth and grow it. That is why we are seeing housing prices grow so disproportionately. They have created a mega bubble in the housing market, and it is bound to pop, but it's not ready yet. As bad as the situation is, it's not chronic yet. There won't be a market crash because much of their wealth is still secured in the housing market, which is still in the phase of growing exponentially. In my opinion, because they are safe in this market which they use to store such big amounts of money, they have no real worry with a poor stock market. They can easily dump crypto and make up for losses through that liquidity, but since the housing bubble is still on track for much growth, they are still safe. The next reason why this is not a market crash is due to the psychology of the market, which can be relatively measured in the volume we are seeing during the sell-offs. Yeah, stocks are falling, but retail and institutions are buying this dip. This proves one vital part: there is optimism that things are okay and strong faith in the market's ability to bounce back. Because of this psychological expectation, the stock market is not going to crash and burn. Instead, it is going to correct itself to a level where investors feel is more correct and aligned with the perceived notion of value, and then start moving back up. We can put the charts of 2008 and 2022 side by side and they look identical, but they are being led by very different reasons. The 2008 market crash was heavily driven by the housing market crash, as people become unable to make payments on their mortgages. Ever since then, new regulations have been placed so that delinquency rates on family residential mortgages decrease. As such, current numbers are really good and back to normal, which means this won't be the catalysts to break the housing market. Also, there was no crypto market in 2008, which also changes the situation. Though the charts are comparable, they are driven by very different and fundamental values due to very different circumstances, and the end result will be very different because of it. People believe in the stock market and its ability to bounce back because there is a perceived notion that even as bad as the economy is, we are making strides to improve, even if they are small. Because of this psychological state, it is impossible for us to endure a market crash. There simply isn't enough fuel to cause it yet. The third reasons why I don't think this is a market crash is because China is still strong. Yeah, I bet you didn't expect that. I believe Chinese economy to have merged closer to American economy to the point where what happens in one will affect the other to certain degrees. More and more, Wall Street investors and other big institutions have been exploring and diversifying their portfolios by acquiring shares of Chinese companies. China has been having a booming economy where they have grown their middle class considerably. Though they have a billion problems to contend with, they still stand strong. There are beliefs that some of their sectors are in a bubble, but that much like our housing crisis, they are not fully cooked yet to pop. Because of strong American foreign diversification of securities, it gives institutions more stability, and since China in particular could be said to have a roaring market and economy outside of the real estate market, it will give investors more balance and tranquility. That's not to demean the catastrophe of Chinese real estate sector, which accounts for 30% of their economy. Depending on how the chips fall, it could unleash havoc everywhere, but so far nothing has changed and everything is falling according to plan. It goes back to what I said, it's okay when things are bad if you know what it is, because you can adapt money to hedge against these losses. Uncertainty is the real villain. China is stable and it will have a big impact on investors in the US, making them more resilient and confident of our own market rather than having them unleash on a selling spree to protect their own pockets. And now that we know why we are in a market correction and why it isn't a market crash, we can finally continue to what to expect from the stock market this week. I want to preface this by saying a lot of what I am saying is speculative, and because of the way the market is falling, it's impossible to be fully confident in the way the chips will fall. Let's begin with the two biggest factors influencing the markets this week, earning reports from the biggest companies in the world in the Fed meeting. Let's begin with the Fed first. The Fed will have their Federal Open Market Committee on January 26. With an economy regaining its lost output, but inflation running highest since 1982 and unemployment rate dropping below 4%, there is a lot of room to think that Fed Chair Jerome Powell will want to justify his policy normalization. Price pressures are deepening with the latest increase in energy prices increases the prospect of an extended run above target inflation. Simultaneously, competition for labor is resulting in high amount of people quitting jobs, since there is so much competition. Companies are not only having to spend more money recruiting and training new workers, but pay more to retain those that they currently have. We expect the Fed to acknowledge that the pandemic, especially with the new variant, are hurting consumer demand for services. Data shows restaurant as well as airports saw a massive drop in numbers at the onset of the pandemic, then slowly recover but now are in a downward spiral again, which is going to mount of pressure for the economy's ability to come back. And the biggest boogeyman of the closet, the Fed is expected to talk about furthering their agenda regarding interest rate hikes. Those are coming and there is no way around them, and I expect the Fed to tell us that we will have one every quarter of the year. Some analysts and experts actually think instead of 4 rate increases, we might actually see 5 or maybe even 6. Fed Chair Jerome Powell said on January 11 that at some point, perhaps later this year, they will start to allow the balance sheet to run off, and that's just the road to normalizing policy. There is room to believe that more aggressive actions on balance sheet reductions can have a big effect in normalizing policy, which seems to be the angle Jerome Powell wants to take. Depending on what the Fed has to say, expect markets to shift to the changes, implying some volatility and perhaps even more weakness. And now, as to the markets, we have earnings season. The markets are going to react strongly to the earnings ahead, and there is plenty of evidence to believe not all the numbers are good. We have big tech, Microsoft, Apple and Tesla, having their earnings reports. Microsoft and Apple are the two most stable and strongest companies, so even mediocre results will not tumble markets. However, Tesla's volatility could easily be the Netflix of this week. But even then, I would not consider tech companies the most important earning reports of the week. I think banks are going to be the ones who either make us or break us. There are so many banks and financial companies having their reports all at once that, if the general notion of the results is less than market expert anticipation, there is a good chance it will set us up for failure. Companies like Tesla will be the snowdrops that cause the avalanche, but don't forget, it isn't the company that will be at fault for whatever happens. There are other major companies like MasterCard, AT&T, Visa, Anthem, Boeing, Johnson & Johnson and other big ones as well. It makes this week the most anxious for markets, so expect volatility to be king this week. If the reports are bad, expect another drop of at least 20% this week on major indexes, so prepare yourself mentally and emotionally for the worst just as a precautionary state. And this leads me to the most important part of the video: how can we as retail investors take the best advantage during these times? Well, let's talk about the purse. In times like this, the biggest mistake done by retail investors is buying stocks all at once. We see a big drop one day and dump the wallet, grabbing as many shares as possible out of fear that we will rise immediately. This is a major mistake, because as you will soon see, market corrections take a couple of days or weeks to finalize, which means we are going to keep on dropping for a little while. Knowing this, the best approach to averaging to the nearest bottom would be to not spend all your cash in stocks at once, but instead, buy assets as the price drops to certain levels. Let's imagine a stock was worth $100, and Friday's market conditions brought it down to $80. The best course of action will be to spend 20% of your cash on it, and then wait and see. When it drops again, to $70 or $60, you spend another 20% of your cash on it. If it starts going up, spend another 20%. Unless you are Nostradamus and know the exact bottom price, you do not want to spend your money all at once. You want to become the best at averaging down to be as near to the bottom price as possible. Another tactic that I know I will get absolutely carnivalized in the comments for saying is, hedge your positions by diversifying your portfolio. Instead of averaging down on a handful of stocks, diversify in different solid companies that you know for sure will bounce back strong, and then after they reach the price target you deem right to sell off, take those profits and put them back in your favorite stocks. This allows me to have an ample portfolio during these times, and because I have not concentrated most of my wealth in a particular stock, it is super easy for me to average down on any position without a lot of work. It's a strategy where math rules and you will easily come out profitable and making a ton of money. I have been talking about some of the best companies out there to buy to diversify your portfolio on my Discord, so come on over if you want to get some ideas. If not, do your research and try to pick the strongest companies that have been affected the most. It's going to be a weird and strange week, with dark days ahead. When I think about GameStop and AMC respectively, and actually taking Saturday to look through the options chain for the companies, I think hedge funds intend on beating them down for weeks to come. MOASS is not going to take place on spring, and I think we will see our beloved stocks getting hammered to the bone even after market conditions start to improve, whenever that takes place. As such, my own personal strategy is to diversify my portfolio for companies I know will bounce back rather than FOMO into GME and AMC all at once. I will continue buying in chunks for weeks and months to come with the gains of these other stocks, averaging down, because I know I will get many more shares doing so. Again, this is my own personal strategy, so you can totally disagree with my take and have your own thoughts to what the future holds. I am buying GME almost every day, but in small chunks, and I see many others doing the same for GME and AMC alike. Be smart with your money and don't spend it all at once. Remember that cash is king during a correction and market crash, so be diligent with your decisions. Due to the volatility and nature of dip we experienced, there is little to no point talking about where we might be headed this week for AMC and GME, since nothing on those charts give me confidence to do a calculated probability scenario. As such, we will skip that part of the video. I want to thank you all for watching this video to its end. I know it was lengthy and it took me 2 days to do all this research and put it all together in a smooth-brained fashion for you, so do let me know in the comments what you think of the video and if you like it. Tell me what you think is happening this week and remember to join my Discord, which is linked below. I will be there answering questions to my viewers and talking about all the best stocks to buy in order to diversify your portfolio during these times. Come join us, there's plenty of cool conversations that I know you will like to be involved in. Hope to see you all tomorrow on the next video, and thank you all so much for watching this one to its end. With all that said, I hope you guys continue having fun today. If you want to support this channel, I have a Patreon link in the description as well as some one-time donation links for Cash App and PayPal. Thank you again for being a part of this channel. I will continue striving for better content. Until then, enjoy the rest of your day and to the moon.